China slows, the Fed worries, and former President Trump strikes back. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on where the housing market is headed.
I do think we're looking towards softness in the future with respect to housing.
And Sonja Gibbs of the Institute of International Finance on the risk and the opportunity of zombie companies.
Money that's being spent to keep zombie companies afloat is money that could be more productively deployed elsewhere.
It was a week of signals, some subtle and some not. China sent an unmistakable signal that its economy is slowing, something that a 10 basis point rate cut doesn't seem likely to fix.
President Xi is confronting a number of both, short-term and long-term challenges. Right now, probably the number one thing is the poor performance of the economy.
While former President Trump kept up his attack on Republicans who supported his impeachment, though Congresswoman Liz Cheney of Wyoming said she wouldn't stop even after she was soundly beaten in her primary.
I have said since January 6th that I will do whatever it takes to ensure Donald Trump is never again anywhere near the Oval Office, and I mean it.
And there was nothing subtle about the inflation signal we got out of Great Britain, coming in over 10% and apparently headed even higher.
I'd go to the UK, where you're seeing an explosive move higher in UK gilt yields, Tom, and I don't think I'm overdoing it using that language.
But the Fed was a little less clear in the minutes from its July meeting, with a nuanced balancing of concern over tightening too much and concern over inflation expectations becoming entrenched.
Reading the minutes, you have to feel that this is a sort of a dovish lead, and it supports Chairman Jay Powell's tone at the news conference following the June 27th meeting. Fed officials noted that some parts of the economy, notably housing, were starting to slow as a result of higher interest rates.
And if you wanted confirmation of just how ambiguous those Fed minutes were, just take a look at the markets this week, with the S&P 500 shooting up on Tuesday, only to fall back down to earth and beyond on Friday, ending the week down 1.2% at 4228. And the NASDAQ was even worse, again climbing nicely early in the week, only to plunge on Friday, ending up down 2.6%. Helped no doubt by concern about bonds, with the yield on the 10-year rising 14 basis points for the week and ending up just under 3% at 2.97. To help us understand what the markets may be trying to tell us, welcome now Bob Prince. He's co-chief investment officer for Bridgewater Associates, and Ed Hyman, chair of Evercore ISI and vice chair of Evercore Partners. So welcome both of you back to Wall Street Week. It's really a pleasure to have you. Ed, let me start with you. You follow the economy and what's going on with the economy. We've talked about the markets. We've talked about the Fed. What's the economy telling us?
Well, the economy has two parts to it, obviously. One part is what real GDP is, or auto sales. Then there's inflation. And inflation is by far the more important part right now. But on the first part, the economy is doing okay. As you know, we survey companies, and our retail survey dropped sharply this week, but still pretty elevated. Housing is really getting hit. But on balance, the economy is doing okay. I think it's probably growing 2 or 3%, but headed to 1%. The rig count, bank loans came out this afternoon, and they're up 11% now. And retail sales this week were, pretty decent. On inflation, which is much more important, I'm pretty convinced that inflation is slowing. Oil prices came down, gasoline prices came down. And in the weeds, used car prices dropped about 3% in the latest month. And we survey retailers' pricing power. That's now plunging. You've heard the stories about the inventories being high, and we have been tracking that for a long time. It's now really coming down. But the most important part, and we don't get much data on this, are wages. And obviously the labor markets are very tight, but they had, from the conference board this week, a measure of CEO confidence. It was almost a record low. And then another survey that showed 80% of workers were concerned about losing their job. go figure that. But we survey employment agencies every week and ask them, among other things, about wage pressure, and that's now pretty clearly hooked down. So I think you're beginning to see some moderation in wages on top of, prices now cooling and the economy's cooling.
So, Bob, Ed sees inflation starting to come down. The question is how fast it's coming down, but starting to come down. How do you see it? And is it coming down enough and fast enough so the Fed will not have to go much further in rate hikes?
It's definitely on the down, but the question is, where does it settle out? And does it settle out at the level that the Fed expects it to and that the markets are discounting? The markets are discounting 2.5. And, we're coming down from 6. Or higher on the core, right? But there are really two big imbalances in the economy right now that need to be resolved through this tightening cycle, and we're still in this tightening cycle. It's too early to really see the effects. It hasn't been that long to see the effects, and so chances are you're going to get more of that weakness as you go along. But there are two big imbalances in the economy right now that are going to have to be resolved. One is the level of nominal spending in relation to the output capacity of labor. Over the past year, nominal spending is up 10%, and incomes are up 10%. And if incomes are up 10%, that gets spent, and you get more spending at 10%. So you got to bring incomes down. And if incomes are growing by 10%, but labor can only produce goods at the rate of 4%, you get a 6% inflation rate. And that's the first imbalance, and that's the basic cause of the inflation that we have right now. It's really not the supply chains, it's just too much spending, which came from the monetization of government debt and the fiscal stimulation. The second imbalance is the level of nominal spending in relation to bond yields. So nominal spending is even higher above bond yields than it is above output. It's 7% above bond yields. So it's the highest in 60 years. So if people's incomes are growing well beyond bond yields, it's very easy to make debt service payments. And even if you lose your job or commodity prices go up or something, you can get credit. And so the credit numbers that Ed's referring to, loans up 11%, that's a backstop on the economy and spending. So it's the high level of spending and income in relation to interest rates and labor production, and it's the availability of credit to sustain that. And that all means that you have to get a tightening of monetary policy and a sustained tightening of monetary policy to bring about an equilibrium.
So it strikes me that Bob brought us back to wages pretty quickly there. That's one of the issues here of wages. You said that's the hardest to get your arms around. Where are we with wages and that wage price spiral? Because in fact, if we are going to have continued inflation, people are going to want to make more money. They're going to go to their bosses and say, you need to pay me more. Well,
CEOs now are really bearish. So they're not going to be happy if you have a CEO on. But Bob and I think about the same way. But money growth has been slowing for about 18 months.
Well, talk about that, because it was growing gangbusters for a long time. Right. But you're saying it's turned around. So in the conventional way, you had the checks, you had quantitative easing and low interest rates. And so money growth got up to almost 30%, which is obviously extremely fast. And that's why you have the strong nominal growth. Now, with figures I got this afternoon on bank deposits, money growth is well less than 5%. And so we've set up the mechanism for this nominal growth, which is way too fast, to slow down. But that's what has to happen. And obviously, this is a really interesting thing. If it slows down, does it come out of real growth or out of prices? If you have your 10% nominal growth, which everybody can understand, I think, right now it's about 1% real and 9% price.
Right.
And if you go to, say, 5% nominal, what's the mix then?
Right.
but if you take that much money supply away, if the money supply has really gone down, should that fix the inflation problem, or at least take us a long way toward fixing it?
Your total in an economy, your total sources of funds is your sources for spending. And there are three sources. There's money, there's credit, and there's income, right? And so when you get to tightening of monetary policy, they're contracting money, and that's absolutely right. The first effect of a contraction in money is on asset markets. Because if you think about the printing of money by the Fed or any other central bank, they print the money and then they go buy bonds, or they print the money, and that money then goes into stocks. So that money most directly affects the financial markets. Credit more goes into spending, right? Because you take out an auto loan to buy a car, you don't take out an auto loan to buy a bond. And the Fed doesn't print money to buy a car, they print money to buy financial assets. So what you have is a push-pull where the contraction in liquidity from the central bank is a drag on the financial markets, while the expansion of credit is a support to spending. And so you got that working in both directions right now.
Well, but Ed, that's interesting to me, at least. Credit's going up. That sounds like it's good. It's going to spur growth. But that makes it sound like that's actually going to make the inflation situation worse. Does the Fed need the credit to come in?
So probably. So in my view of it, which is a straight Milton Friedman take of it, of those three pieces that Bob pointed out, the first one is where it starts, is the money growth. And I track global short rates. It's a global economy, and they have a higher impact on the U.S. economy than Fed funds. And they've been going up for about 18 months, same time that money growth has been slowing. So I think we're pretty deep in this. And we had a pretty good drop in the stock market, to your point. And now inflation's coming down, and the markets are beginning to think that this is an introduction to the next chapter, that the next peel of the onion.
He's exactly right. So the money is the first thing, right? But and money is the first thing, but it needs to get to the second thing and the third thing to have the permanent effects, right? Which means you have to be in a tightening cycle for long enough for that to happen, right? And we've been in a tightening cycle for how many weeks, right?
If you look at global,
you're right, 18 months, exactly.
Right.
But you have to be in it long enough, right? And so, as we look forward, we think that there's going to be, it's too early to tell, really, how this plays out in terms of whether it's weak growth or high inflation or which one. But you're probably going to get some combination of weak growth, high inflation, and rising interest rates. Right. And all three of those are rough on asset prices. And the mix is going to be determined mostly by how aggressively the Fed and other central banks tighten and stay tight if they have to pay the price of a downturn. And
that's just where we're going to turn next. So what does this really mean for investors? It's too soon to tell. What do we do in the meantime while we're waiting for those answers? Bob Prince and Ed Hyman will be back with us for more Wall Street Week after the break.
New construction contracts faltered, and while unemployment actually went down, more significant was back-to-back monthly declines in paying jobs. The bottom line seemed to be that the economy was beginning to move forward, but with many a lagging part, and overall at a pace that would embarrass a tortoise.
That was Louis Rukeyser on Wall Street Week back in August of 1991, when the United States had just come off of a relatively mild and short recession. The #1 song, if you remember, was Bryan Adams' "Everything I Do It For You," and the top movie was Terminator 2: Judgment Day. Still with us are Bob Prince of Bridgewater and Ed Hyman of Evercore. So it's a bit of a different world today, Bob. For example, on the job situation, we still have a pretty robust jobs economy. But from everything we discussed before about the uncertainty of where we are in the tightening cycle, what comes next, what does that say to an investor?
Well, right now we're in an in-between stage right now, right? So if you go back just not too many months ago, it became evident that we had a self-sustaining inflation, that there was going to be a tightening in monetary policy. The markets priced that in, yields went up. You got the tightening of policy. It's still happening. It's not over. Markets got a little bit excited about the dip in some of the inflation. They started to bite on that yield. But that we've already given up half of the yield rise that occurred, and that actually means the Fed needs to do more than if the yields had stayed up where they were, right? Including equity. So we're still in this thing. We're still in this tightening cycle. And like I said, there's going to be a mixture of three things, and you don't know what the mix is yet because it's too early to tell, but you're going to get some mixture of weak growth, high inflation, and rising interest rates. The more the interest rates rise, the more it's the weak growth. The less the interest rate rise, the more it's the high inflation. And if the Fed takes the foot off the brake, you're going to that inflation improvement's going to go away, and they're going to favor growth. So you don't know how they're going to play it quite yet. So what we try to do in this kind of environment is maintain some balance, right? Diversification, obviously. Not too heavily committed to any one direction, but also even within the equity market, structuring equity portfolios that have a cash flow and balance sheet base under them, so that if the tightening is very aggressive, that there's a strong enough balance sheet to hold that up to sustain their position in the markets or sustain a positive cash flow. And I think that the companies that have a lot of debt in relation to enterprise value or vulnerable profit margins, that sort of thing, are the type that are most vulnerable for that environment.
So it sounds like an awful lot hinges on the Fed. Surprise, surprise. Jackson Hole coming up next week, okay? A lot of people are going to pay attention to Jay Powell, what he has to say. If you remember last year at this event, he was talking about transitory still. That doesn't work so well this year.
Right.
So how much guidance can the Fed give us about exactly where they're heading on some of the questions that Bob just talked about?
Well, it's hard to know. I do think we're going to get a financial crisis somewhere pretty soon. It's always been part of the tightening cycle. But like you point out, David, last year it was really about transitory. He had what you went through, 5 different things that were proved transitory. And I personally think the Fed is now on the other side of the wrong foot. Now they're doing the entrenched. And a year ago I thought bond yields would go to 5% and Fed funds go to 5%. And I'm not quite sure what's happened, but money growth did slow dramatically, and commodity prices have come down dramatically. And now I'm seeing pricing power coming down. And so I think we've made a lot more progress on inflation than I expected. And that's why the market was going up until today. But that's if inflation keeps coming down, then the market is going to appreciate that.
So one thing I don't understand, Bob, we heard why Ed thinks the Fed's job maybe has gotten a bit easier, actually, with some of the things that have happened. But financial conditions actually have not tightened. Actually, if anything, they've gotten somewhat looser. That makes the Fed's job harder, does it not?
In recent weeks.
Yes.
Yeah, I mean, the first half of the year, literally the first quarter, the markets were doing the Fed's job entirely.
Yeah.
And then the Fed joined in, and once the Fed joined in and the market saw some, positive signs of inflation, they actually pulled back. And so bond yields came back down, equity yields, came back down. And so, that, as you said, about half of the tightening that the markets were applying has been retracted. Mm-hmm. If yields had stayed where they were, it would be that much less that the Fed needs to do. But the fact that the yields have actually dropped some and kind of given back some of the work that they were doing, it's that much more that the Fed needs to do. And so I think, Ed referred to you raised it, and we talk about last year's Jackson Hole speech,
yeah.
But they were clearly wrong about transitory inflation. If you actually look at the indicators that they follow, and they tend to be lagging indicators, I haven't heard yet an explanation about how they think inflation, why they think there is an inflation, why they think that was wrong. And I think that caused you to question how well this process is going to be managed. It's going to be very tricky.
Well, Ed, that's a really powerful point, I think. Does the Fed need to explain to us what went wrong and why they're not going to do a mistake again for us to really believe them this time?
Well, it would be helpful. But, from my vantage point, as you can see, what they missed was that fiscal stimulus, quantitative easing led to a 30% increase in the money supply, and that did it. And if you look back at that Jackson Hole, they completely missed that. Now, money growth is plunging, and commodity prices are coming down, all sorts of signs, that early signs. And so the job's not over by any means, but there's progress. And if you look back, like particularly at the 70s, when inflation peaked, the stock market started to respond to that, when you had a very high inflation period, like we have now.
Do you agree with Ed that in all likelihood we'll have some sort of financial crisis, that that's what happens in serious tightening cycles?
Odds are pretty good, yeah. Yeah, I mean, we haven't had enough tightening yet to really have that, but odds are good, yeah. I mean, we haven't had the downturn yet. If there's going to be a downturn, it hasn't happened yet. It's going to be hard to bring inflation down. How are you going to bring nominal spending down from 10% to 5% without a significant contraction in credit? You need to slow credit growth by about half. Money growth is slowed, but you need to slow credit growth in half, but it's still rising. You're going to have to hold interest rates up enough, and that's when bad things happen.
I have to tell you, this is not a bad thing. It's a real treat to have the two of you here on Wall Street. We really thank you so much. That is Ed Hyman of Evercore and Bob Prince of Bridgewater. Coming up, we'll take a look at what's coming up next week on Global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Let's take a look at what's coming up next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. After unexpected cuts to the medium-term lending facility in China, we'll be looking to see if the banks follow suit with a cut in the loan prime rate. Also on the slate are interest rate decisions from central banks in South Korea and Indonesia, inflation figures from Singapore and Hong Kong trade data. Earnings across the region include Qantas, PetroChina and food delivery giant Meituan. Bloomberg Intelligence forecasts Chinese companies may be set to report their worst earnings performance in 2 years.
The focus in Europe for the coming week will be the energy crisis in Europe. Now, we had a lot of developments in the week prior. You had the Rhine dropping to levels that made it untenable to have shipments across it. You had record high energy prices in France, in Germany. You also had nat gas prices reaching new records as well. So as we head into this week, the question is going to be, how will this impact industry? How will it impact individuals? Will there be more demand rationing and demand destruction? We've already seen some of it with different industry having to shut down power plants, but how much worse can it get, and what will be the impact on the economy?
Big week in economics. We have the Jackson Hole Symposium coming up, and I think our Bloomberg economics team really focused to hear some hawkish comments from Chairman Jay Powell, reassuring the markets there was no dovish pivot and that we are still a go in September for 50 or 75 basis points. Away from economics, back to some of the fundamentals as well. Big week for earnings too. Zoom, of course, the video conferencing company. How do they sort of continue to grow in the face of further reopening trade and maybe less demand for that product? Finally, Peloton. We've heard a lot from this company about assembling some of the bikes at home, a lot of cost-cutting initiatives, all to help sort of get that company back on track. That, too, will be a key focus for us next week.
Thanks to Juliet Sally, Danny Berger, and Taylor Riggs. Coming up, you know what Warren Buffett says about the tide going out. Well, some of those who may be caught are those so-called zombie companies who've loaded up on debt when it was cheap. We talk about the risks and possible opportunities with Sonja Gibbs of the Institute for International Finance. That's next on Wall Street Week on Bloomberg.
It was nice while it lasted. All that support from the Fed, from zero interest rates.
We continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate.
To pumping money into the economy more directly.
We are deploying these lending powers to an unprecedented extent, enabled in large part by the financial backing from the Congress and the Treasury. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery.
all of which allowed companies to borrow as much as they wanted, which was worrying to Russ Kostrick of BlackRock as much as 4 years ago.
The 800-pound gorilla, which eventually we're all going to have to question, is whether or not this buildup in corporate leverage, which we've seen over the past 3 or 4 years, is that sustainable?
But now those happy days are over, as the Fed has reversed course and says it will keep raising rates until the inflation dragon is slain.
The idea that we are going to start cutting rates early next year, when inflation is very likely going to be well in excess of our target, I just think it's not realistic.
Where does that leave all those companies who've borrowed so much? Well, at least some of them are so-called zombies. No, not those zombies. Companies that don't generate enough cash to pay their debt. And that leads economists like Nouriel Roubini to say we're going to see some of them fail, which may just be what we needed to get to the other side.
There were tons of firms that were highly leveraged, didn't have much profit, they were zombie, they would have gone bust, but during COVID, we bailed out everybody. 0 rate, negative rates, quantitative easing, credit easing. Now that we have to tighten, as inflation is higher, the zombies are going to collapse.
And to take us through this strange and exotic world of zombie companies, welcome now Sonja Gibbs. She's Managing Director and Head of Sustainable Finance at the Institute of International Finance. So Sonja, thank you so much for joining us on Wall Street Week. Let me start with those basic of questions. What exactly is a zombie company and how many of them are there out there?
First of all, to take a step back, what you need to think about is that over the past 10 or 15 years, global debt levels have skyrocketed. We've had very low interest rates. And for example, non-financial corporate debt around the world is now close to 100% of GDP. And that's more than double what it was a decade ago. So that's a very worrying backdrop. And so what we mean by zombie companies is a company that essentially has to borrow to keep going. They are highly leveraged, they're not growing very fast, their revenues are not up to par. And at the moment, they face a very difficult situation. You've got higher input costs, so your commodity prices are higher, wages are rising. At the same time, you don't earn enough revenue to cover all of these higher costs and your debt service. So if you have a ratio of revenues to interest costs that's 1 or less, if you can barely cover your debt service costs, we call you a zombie company. And it's a very good name. It's very evocative. And for how many? I mean, it's difficult to calculate, right? Because for a lot of firms that, for example, aren't publicly listed, the information might be less available. They might be smaller, non-public companies. But the Federal Reserve estimates that between 5 and 10% of U.S. firms fall into this category. I think it's also important to remember that this is not a static world. It's not once a zombie, always a zombie. Conditions change. And in fact, becoming a zombie company is a little bit cyclical in the sense that when times are good, maybe interest rates are low, growth is high, maybe you're not a zombie. But then, you know, bad things happen. Pandemics happen, shocks happen, interest rates go up. And a company that was formerly doing reasonably well might suddenly fall into the zombie category.
So you mentioned the overall debt load, which is true certainly in the United States, and not just in the United States, in part because interest rates were so low. There are some very, very successful, healthy companies that loaded up on debt because it was so cheap. And whenever we've talked about this risk in the last few years, they said, don't worry, as long as interest rates are low, we're fine. It looks like those days may be on their way out. We're going to have higher interest rates. So what kind of pressures does that put on these zombie companies?
Well, I think it's a good analogy, right? It's all fine until it's not. And so you've had a kind of a confluence of factors that have hit pretty much at the same time. You had a pandemic which hit growth. You had a commodity price shock. You have rising inflation. You have higher interest rates. And you also have firms whose business models, for example, have been entirely changed by the pandemic. I mean, amongst the list of zombie companies, you might find a company like WeWork, you know, a company that has been very successful, but at the same time, the pandemic has changed a lot of things for that company. Carnival Cruise Lines is another good example of a type of company who's now in the zombie category, or some of the meme stocks, you know, AMC or GameStop. So these are really household names. And I think that the difficulty is, at a point in time when you've got wages rising, when you have higher input costs. These firms may not be able to borrow as much as they need to borrow to keep afloat.
So do you tend to find zombie companies concentrate in certain sectors or in certain size corporations?
So I think it's fair to say that the sectors that are worst off in terms of percentage of zombie firms are probably in manufacturing and in retail. And retail, of course, is an industry that's undergoing secular change over the long term as we move to sort of more online, less brick and mortar. I think there are underlying structural issues there in that sector in any case. But I think some of the companies that are hardest hit tend to be smaller firms. And if you think about a small company, they're sort of inherently face greater credit risks than some of the larger, better established companies that have long-standing histories and track records in borrowing. They're, familiar to investors. Smaller companies have a harder time accessing funds, especially when borrowing conditions are difficult. And with some of these companies having fallen on hard times during the pandemic, there are estimates that suggest that in some cases as much as 25–30% of the small cap companies, especially if you include unlisted companies, could be falling into this sort of zombie trap.
I wonder, Sonja, about the larger effects on the economy. Obviously, we don't wish ill for any corporation, but there's going to be a lot of stress put on a lot of the companies you're describing right now. Insofar as that all gets sorted out, to use a euphemism perhaps, is there some benefit for the economy in redeploying the capital they represent into things that might be more productive than their enterprises?
I think we might want to think about this in a short-term and a long-term context. So in the short term, it is very helpful for the economy to keep these companies afloat. And you could think of the example of Japan here, which has spent over $800 billion since the pandemic hit to support its companies. So you avoid bankruptcy, you keep people employed, you keep these companies afloat. But there's a longer-term cost to be paid for that. Because when you think about it, money that's being spent to keep zombie companies afloat is money that could be more productively deployed elsewhere. You could put it into capital spending. You could put it into infrastructure. You could put it into new industries, new technologies, maybe in the ESG world or green technology that can really deliver a boost to productivity and growth. So it's kind of a foregone opportunity in that sense.
At the same time, for the reasons you described, and the example of Japan is a good one, it strikes me, there are political consequences of letting zombie companies go belly up.
Well, the politics of these things are always difficult, right? I mean, one of the conclusions that you can come to is that if you have a high proportion of zombie companies, if you have companies that you're worried about keeping afloat, there's political pressure to keep that going. The more that borrowing costs rise, the more that interest rates rise, the harder time these companies will have keeping going. So if you're in a world where inflation is rising and you have central banks having to make a very difficult balance between controlling inflation and supporting growth, which can involve supporting some of these less profitable companies, it's a rock and a hard place. Where do you draw the line?
I wonder, Sonja, if in fact the Fed could be held responsible for this many zombie companies. And maybe it's not with their intent, but it certainly was a consequence of extraordinarily low interest rates for a long time.
Well, I think ultimately, as arbiters of the price of money, you could hold the Fed responsible for everything, really. But certainly it was an inadvertent consequence of low interest rates. I mean, if you think of the many, many years when we had low and in some countries even negative interest rates, there were warnings sounded all the time. There are risks to financial stability. There are risks to long-term growth. It's going to stoke inflation. It's going to distort financial markets, distort asset valuations. And in fact, you can think of zombie companies as a type of distorted asset valuation, right? Because a company that cannot generate enough revenue to support its debt service and its running costs arguably is trading at an inflated valuation because it can continue to borrow at low rates. So you could sort of put it on the backs of central banks, but it's certainly an inadvertent consequence of something that had to be done to keep growth going during after the financial crisis.
Sonja, thank you so much for that tour of the exotic world of zombie companies. That's Sonja Gibbs. She is from the Institute of International Finance.
Pleasure to be here.
Coming up, we wrap up our week with special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We're going to wrap up the week once again with our special contributor, Larry Summers of Harvard. Larry, thanks so much for being back with us. So let's start with those Fed minutes that everybody was waiting for eagerly, and they came out. The markets didn't know quite what to do with them. What did you make out of those minutes?
They confirmed what I suspected, which was that the Fed doesn't know where it is, that the world is very ambiguous at this point, and minutes of a meeting are a very poor way to convey a collective message. Look, the Fed has a fundamental problem about which it is not yet willing to be realistic, and that is that it is exceedingly unlikely that inflation can be brought down to target levels without a substantial increase in unemployment. They want to be very concerned about unemployment and about inflation. And the reality is that it's probably not so realistic to think that they're going to get inflation all the way down without getting unemployment up. And they don't want to acknowledge that, and that forces a certain confusion into all of their statements. I can sympathize and understand why they don't want to acknowledge that. Part of the problem is they've taken on an excessive obligation to communicate. So I think they're in a very, very difficult situation. I don't know to what extent they're going to choose to take the pain that is ahead on the stag side, and to what extent they're going to choose to take it on the inflation side. That remains to be seen. I suspect in some ultimate sense, they don't really know either which way it's going to go. It's got to worry them that financial conditions are now materially looser than they were when the Fed last met. And when in the middle of a tightening cycle, financial conditions are substantially loosening, that has to make a central bank nervous. David, there's one other aspect of this situation that I think is very important and under-recognized. And that is because everybody focuses rightly on the geopolitics, what's happening with Russia and Ukraine, what's happening with droughts, all of it. They don't really fully internalize that oil prices and wheat prices have both come down substantially and are predicted to come down substantially in the future. That's what's driving the relatively limited inflation expectations. And those who were quick to focus on concepts of core inflation when headline inflation was higher than core inflation can't stop doing that when headline inflation is lower than core inflation. And I don't see that we're really making any great progress with respect to core inflation. I don't see it with respect to the wage numbers. I don't see it with respect to the median or trimmed mean measures. And so I think we've still got a substantial inflation challenge ahead of us.
One of the things the Fed emphasized in the minutes, besides really being concerned about inflation expectations, on the other side of that was a softening housing market, something you referred to last week on this program. Give us your take of the housing market. Some people say we're in a housing recession right now.
So I think you have to distinguish movers from stayers, or to put it differently, you have to think about what the right way to look at rents is. Here's what's true. What's true is that last year, people who were signing new leases or buying new homes were paying 15 or 20% more than they had a year ago. Nothing like that fed into the consumer price index or the Fed's preferred measure, the PCE index. All that fed through was the small fraction of people who saw their rents change and a constant rent for everybody else. What that means is that down the road, like now, you're seeing inflation not because new leases are going up so fast, although they still are going up at a reasonable rate, but just because the people whose leases are coming up are seeing substantial increases. And so we're going to see significant housing price inflation in the measures of inflation that are used probably for another 6 to 9 months. That's a different thing than what builders are responding to. Builders aren't responding to that. Builders are responding to what they think the price of houses will be a year from now, and that come down. And so we're seeing a slowing in building, and that's what happens when interest rates go up. In some ways, it makes sense. If we're going to have a decline in economic activity, it's better to have a decline in something where we've already got a huge stock of it, and it's only the new flow that's being affected, than in something that we need to consume on a continuous basis and that doesn't have any duration to it. But I do think we're looking towards softness in the future with respect to housing, and I'm sure there'll be differential impacts in different parts of the country. As I say, my best guess is that we will have a meaningful recession sometime in the next 2 years. And if so, I think there's considerably more pain with respect to housing ahead.
Larry, when you talk about softness and slowing, we certainly saw that in numbers coming out of China at the beginning of this week. And I wonder what you make of the Chinese problems, as we know there are 3 or 4 of them that are interlocked there. But on the other hand, is it possible that will give at least a little relief to the Fed here on slowing inflation?
I think it probably will. It goes back to the issue we discussed a few minutes ago, David, about oil prices and grain prices. The main impact of Chinese slowing is likely to be on commodity prices. And there's a question as to how much weight those should be given as we think about our inflation rate in this country. But it probably is a positive on inflation. I think the larger questions involve how we see China in the future and how China will be responding to these economic difficulties. These, as I've been saying now for some time, are looking like increasingly profound events in China. It was taken as almost axiomatic 6 months or a year ago that at some point the Chinese economy would surpass the American economy in terms of total GDP at market exchange rates. That's now much less clear than it previously was. And I think you're seeing all kinds of challenges for China. There's the huge financial overhang. There's where the growth is going to come from. There's the growing Communist Party involvement in a wider range of enterprises. There's the demographic challenge. I have been saying for some time that I think people are going to look back at some of the economic forecasts about China in 2020 in the same way they looked back at economic forecasts for Russia that were made in 1960 or for Japan that were made in 1990.
Larry, one last one here. Toward the end of the week, Turkey's central bank made a move to try to combat inflation by, you won't believe this, cutting the interest rate from 14 to 13%. This, of course, is part of President Erdogan's theory of interest rates and inflation. What did you make of that?
President Erdogan is the world's first practical modern monetary theorist. he is putting modern monetary theory into effect. So far, it hasn't worked very well for him or for the Turkish people. I don't think that's going to turn around. And I hope that the misguided acolytes of modern monetary theory in the United States are watching.
Okay, Larry, thank you so very much. That's Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, we all know getting older makes us slower and grayer, but can it also make us richer? That's next on Wall Street Week on Bloomberg. Finally, one more thought. Getting old. It's one thing that we all have to do, and none of us wants to think about it. And it sometimes seems like some of the oldest among us may be the deepest in denial. Whether it's rock musicians like Mick Jagger, still performing live on stage at the age of 79, or Sir Paul McCartney, who's still going strong way past that age of 64 he once worried about. Or our political leaders in or nearing their 80s, like President Biden, and Mitch McConnell and Nancy Pelosi, who snapped back at a reporter 10 years ago when asked a question.
Some of your colleagues privately say that your decision to stay on prohibits the party from having a younger leadership and hurts the party in the long term. What's your response?
We always ask that question except to Mitch McConnell.
And who can forget President Ronald Reagan, who in 1984 provoked the age-old, or should I say old age, question after stumbling through his previous debate with Democratic challenger Walter Mondale, only to come back with this zinger.
I will not make age an issue of this campaign. I am not going to exploit, for political purposes, my opponent's youth and inexperience.
The world of business and finance isn't entirely immune from this, led by Warren Buffett, who at 91 shows no signs of stepping down and told our own David Rubenstein his goal is to keep going.
Well, I'd like to be the oldest man that ever lived, actually.
And who knows, maybe we don't really just get older, we get better. For those of us hoping that that may just be true, we now have a concrete, provable example coming from the world of golf, where a journeyman tour professional who'd struggled for years suddenly became a star simply by turning 50, pushing him into the older player PGA Tour Champions League. To be sure, Stephen Alker from New Zealand happened to be at the very top of his game when his birthday came around. But according to the Wall Street Journal, adding that extra year has led him to make in 1 year $3.5 million, which is more than he'd made in all the rest of his career put together. And if he keeps sinking extra long putts like he did to win the Boeing Classic,
that's the way to get it done.
He may just be getting started. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.